the imbalance here. It goes over a little bit, that's okay. But inside this range in here, more specifically, the order block, the hourly right here, that's where your fill would be, or aiming with your limit order. And the heat on the trade would be on this candle's movement there. But your stop would be above here. But you're aiming for a very large downside objective. So the risk from entering here at the bottom of the hourly bearish order block, which is again represented by the bottom of that rectangle here, you're entering there. The heat or the drawdown in the trade is limited to just that candle. But your stop has to be here, and you're expanding lower for a target that's many times over what your risk is. Dropping down to a 4-minute chart, here's that same order block from the 5-minute perspective. It's a little skewed now because we're looking at 4 minutes. Each candle's 4 minutes in duration. Market trades up into that, hits it perfectly. Not that it's linked to anything on the 4-minute chart, but it's linked again to that 5-minute chart. Hits it right there beautifully, trades lower, comes right back up, trades into the top end of that fair value gap on the higher time frame before we start dropping down. We have a little bit of movement above it, and that's okay because this market is very volatile right now. You can't demand the markets to always deliver with this level of precision. Sometimes you get this little coloring outside the lines, and that's okay. That's a matter of experience and time studying it and doing it. You anticipate a certain measure of imperfection and still submitting yourself to the idea that just because it went above that level doesn't mean it broke it and it's going to keep going higher. It's likely to do that, and if it does, don't freak out. Then the market trades lower and reaches for those targets. Now, what I want you to think about is when you see these patterns for entry, now tonight I taught you how to look at market structure from an advanced perspective. I already know some of you are going to be very confused by this lesson, and I understand your confusion, but that confusion is reduced by you going in and looking at price data and start studying it and looking at it. The idea is this. When you see an imbalance get rebalanced, the high formed as it rebalances, that high should not be violated by price going higher than that if you're bearish. If you blend that with institutional order flow, what is institutional order flow? When you're bearish, all of your up close candles should keep price from going higher than them. What does that mean? We have an imbalance here. The market trades up into the bullish candles that are on the 5-minute chart. We're on a 4-minute chart. That's that red level here. Let me go back up to so you know. That's this one here. This is a down close candle right there. These are the last two up close candles before the displacement here and imbalance. The market trades back up into that right there. There's your bearish order block. It's aggressive, but if you know what you're looking for, that's very, very fun to do that. On the 4-minute chart, there's that same return back to that 5-minute bearish order block. Watch what happens. Market breaks lower, so we have up close candle and up close candles. The market trades higher, yes, but does it overtake this up close candle? No, it just trades back up into it a little bit, but doesn't go above it. Wow, that's important, because if it doesn't overtake these up close candles here or here, it doesn't even need to get to these because it hasn't even overcome this one. So it acts as real resistance. That's institutional order flow. Your market, when it breaks again from the consolidation in here, all of these up close candles never get reached into again here at all. But notice what we've got over here. We have up close candles. The market leaves it. Then it comes right back up. Does it overtake these up close candles? No. So it's going to remain heavy. So in short, I've taught you tonight to look at the markets from a market structure perspective by breaking down the price swings, labeling them, specifically an imbalance that's rebalanced. That intermediate term high or low should not be violated. That's a key high or a key low. That sets the stage for a market move that should unfold and deliver to a higher time frame objective. If you combine that logic with market structure and the imbalance rebalance becomes intermediate term highs and lows, those key highs and lows, with them not being violated, if they are violated, that means your idea is wrong. And you cancel the idea and you don't try to go in and force it again and overtrade and blow your account. While the market is moving in your favor, you're going to continue to trust that move and hold on to your trade, because if you're bearish, up close candles should keep price below it, or them if it's multiple up close candles. There are speed bumps. They may come back up and touch them and act as a what? Bearish order block. But you do not want to see them traded above if you're bearish. And vice versa. If you're bullish, when price is moving higher, generally the candles will be predominantly green in my case, because I'm looking at green candles when it's going higher. Whatever your candle color is on your platform, predominantly there's going to be more up close candles when it's bullish. But down close candles should support price. If it trades back down to them, it's going to act as a support structure for an order block. So I've given you two main components to market structure and institutional order flow. How to know when the move is still good and not be afraid. And how do you know when the move is likely to be dynamic? And how do you know when the idea is probably flawed and your interpretation or your analysis is wrong? If that intermediate term high or low is broken after your trade idea becomes possible, if that intermediate term high is broken and you're bearish, then you got to move to the sidelines and don't go in again. Wait for more setups in the future. You just can't force it. I taught you institutional order flow, which is, again, I've already mentioned this in the previous lessons, where we're bullish and we're expecting a price swing higher. Generally, there is not a lot of down close candles in that price swing higher. But those down close candles should support price should it trade back down into them and not see them overlapped, in other words, going down below it. If it does, it's only permissible if there's a short-term low in close proximity to it, and it's then likely to just go down and take out some sell stops if it's bullish and then reaccumulate and go higher. If there is no swing low, there would be no swing low with sell side below it, so there's nothing to concern yourself with. Just look for down close candles to support price higher.